Bain Capital and Carlyle Group have made a €3.4 billion bid to buy the German lighting firm Osram Licht, capping off months of negotiations. A potential deal would end Osram's relatively brief period as a standalone company. Remember, it was spun off from Siemens in 2013. To talk about this deal and kind of what it means, joining us now from Berlin, Syed, private equity and deals reporter here at Bloomberg News. I guess the first question, Sarah, is why did it take so long?
It's a very good question, but I mean, we first reported back in November that Bain, as a standalone, just by itself, was looking at investing in the business, and then they teamed up in February. I think, you know, there are a couple of factors at play. The company suffered from 2 profit warnings within that period, and also it has a massive exposure to the automotive sector. And if you're financing a deal, exposure to the automotive business is not something that financiers love. So it took them a long while to get comfortable with this business and its exposure to the automotive. Plus, having suffered from these 2 profit warnings, it wasn't necessarily the flavor of the day. So getting the financing package in place was the thing that took the longest.
So the fact that they are therefore still doing the deal tells me an awful lot about the demand for deal flow, the fact that they need to get deals done. They've got a lot of powder. It needs to be put to work. Like, in normal times, in more normal times, would a deal like this have been done? Because the IRRs can't be great.
I think that's a very good question, and you know, people have often speculated whether, you know, there's a correlation between an increase in public to private transactions and a peak in the market. But if you actually look at P2Ps being done at the moment, there's a real conviction and motivation to do them because they are, the stocks are at bargain prices at the moment, and PEs, as you rightly say, are loaded with capital that they need to spend, and private auctions are very competitive and very expensive. So you see these private equity firms scouring the listed markets for good businesses that are a little bit underloved and really shouldn't be listed anymore. I mean, June in the UK was one of the busiest months for publicly traded companies and take privates in almost a decade. So I think these deals are a result of a certain momentum that has been building with private equity firms.
I was talking to Ken Moelis the other day, and he was talking about this, and he was talking about the fact that you've basically got this huge market, I guess you call it a dark market, of basically private equity assets that just get passed around, that they get done, you get the first deal, you get the take private, then there's an improvement in the operating performance, then there's a refinance and maybe a sale, and it just gets, these companies never come back. Is that what we're now looking at?
I mean, I think it's been quite a long process for PEs with this so-called the parcel deal, and, you know, they're being passed from pillar to post from one private equity firm to another. And another thing that we've been seeing recently, and we had a couple of examples of this earlier in the year, where private equities are going back for so-called seconds. So they will own a business, list the business, and then realize, oh, hang on a second, there's still quite a bit of value to be extracted in the business, so let's go back to the business that we once owned and take it private again. We've seen a couple of those instances as well, and I think that there are certain businesses where there aren't necessarily strategic players that could buy the business, so it makes kind of natural sense to go to be acquired by a private equity firm.